Hi everyone, Adam O'Dell here, Chief Investment Strategist of MoneyandMarkets.com. I'm here with my research analyst, Matt Clark, and we're doing another series of Ask Adam Anything. Just as a reminder, you can ask questions here on our YouTube channel in the comments below. We've got a couple from last week that was well received. We've got a couple questions we're going to hit this week, or you can also write into us. Matt will give you that email address in a bit. So send us the questions that are most burning that you'd like for me to answer, and I will tick through them week after week in kind of a quick fire fashion. So just as a reminder, Matt puts out a great amount of content based on our green zone rating system on moneyandmarkets.com, and as well as being our lead research analyst for Green Zone Fortunes. And in addition to that, he mans our customer inbox, so he has his finger on the pulse of the questions that folks are asking. So Matt, with that introduction, let's get started.
Thanks so much. I'm waiting for those really deep life altering questions, as if to what is the meaning of life, Adam? I'm really waiting for those. But again, as Adam said, that email address feedback@moneyandmarkets.com. We'll drop that below down here. But yeah, feedback@moneyandmarkets.com, or you can ask a question on our YouTube channel, which is where I'm going to get a couple questions today. The first one, again, we started it this way the last time, and I'm going to kind of focus. I'm going to follow the trend this time, but. One thing that we do at Money and Markets on our YouTube channel is the marijuana market update. Each and every week, I look into the cannabis market, talk about particular trends, stocks, things like that. You can catch that on our YouTube channel, by the way. But today's first question actually relates to that, and it came. The basic comment here is thoughts on MMEDF. MYCOF, which are both tickers, by the way, over-the-counter tickers. This industry in general, what are your thoughts on the speculative market of psychedelic therapy or medicine? Do you have any insight into companies like MindMed or Medicine? And this it actually plays very well for both me, but mostly for you, Adam. What are your thoughts on the industry, and then on companies like MindMed and Medicine, which is MMEDF? And MYCOF, both over-the-counter stocks.
Right. Well, I'm going to assume that you said that plays even better to me, as I went to medical school for a year and decided to go a different direction, not because I need these medications or because I'm a basket case or something. So I'll give you the benefit of the doubt there on that. So I did. I mean, I have very much an interest in medicine and biology and biotech. And so certainly looked into this field. I think it's a very promising field. I mean, just to let everybody know what we're talking about is, drugs that were traditionally looked at as psychedelic and recreational and to a large extent illegal, things like LSD and MDMA or ecstasy, magic mushrooms or psychedelic mushrooms and things like that. There's now medical research showing that that the compounds in those at very low doses can be very helpful and therapeutic for things like PTSD and anxiety, depression, some other psychiatric disorders. So. There is certainly cutting edge research that's going on and some drug trials in that regard. Is it a good investment? That's the thing. I mean, you have to separate the hype, not only the hype, but the promise and the opportunity in a new industry or in a new discovery or a new technology and the investability in that. And, it comes for me down to one word, and that is stigma. So if you think about the cannabis market, how many decades have scientists known, has the medical community actually known, that cannabinoids are actually beneficial for a number of things in the human body? And yet the stigma around marijuana and reefer madness kept marijuana, cannabis outlawed for decades. So, I look at that as, psychedelic medicine is so much further behind where cannabis is, and we're just now getting to the point where we're trying to legalize cannabis, and more so that the social, the culture is willing to accept it. So I think the stigma around psychedelic medicine is just too great right now. I think that investing in it right now, you're going to be way, way, way too early. Most likely the companies that are in the forefront now aren't going to be the most profitable come to market commercialized companies in 10, 15, 20 years when this may or may not actually come to fruition. So, these tickers, MMEDF and MYCOF, if you want to trade them on a very purely technical and speculative basis, go for it. I'm not against that, but I do not see them as good investments right now.
And shameless plug, you can listen to the Marijuana Market Update each and every week here on our YouTube channel for Money in Markets. I'd be remiss if I didn't drop it. So now in recent weeks, you, myself, and Charles Sizemore, co-editor of Green Zone Fortunes, we've talked a lot about the energy sector. We've talked a lot about commodities. And that kind of leads me into the next question here that came from our YouTube channel. And that is, are you bullish on drilling companies like Transocean Rig? And this could look at both as not so much as a commodity, but more so on energy stocks or something like that. So I guess I'd ask you, are you bullish on drilling companies like Rig?
I am in a contrarian sense. I mean, I listened to an interview from Salem Abraham, a trend following legend, a little while ago, and he was basically, he lives in Texas and he's intimately involved in the oil industry there and is friends with the late T. Boone Pickens. And he was talking about the utter dejection, about people just throwing in the towel and they've made a life of themselves in oil and gas and they're just quitting now. So that to me as a contrarian is a buy signal. You have to be careful though. I mean, if you run RIG, ticker symbol RIG, Transocean, through our 6-factor green zone rating model, it does not rate well overall. It rates a 35 out of 100. So it does means it is not a well-rounded stock. Now that's not surprising. That's because a lot of the data is backward looking. We look at growth rates historically. The growth rates, their business is contracting at the moment. We look at a quality score. So profit margins and earnings and cash flows and things like that, those have also taken a hit during the oil slump. So this particular stock, RIG, is not going to score well on quality. It's not going to score well on growth, on volatility, and on size. It also scores low. The two of the 6-factor scores that it scores highly on are value. It scores 87 out of 100 on value and 85 out of 100 on momentum. And you think that those two are diametrically opposed. But when I was coming up in the industry, one of the strategists that I learned from, he said that you want to look for assets that are cheap, hated, and in an uptrend. And that basically means that on a price to book or price to earnings level, they are cheap. That they are hated, meaning sentiment is very far against them. And that kind of speaks to what Salem Abraham was talking about. If everybody's giving up on something, if there's blood in the streets, that's typically a good time to be a contrarian buyer. And then an uptrend, it doesn't have to be in a multi-year uptrend. It could be in a new uptrend, meaning over the past 6 months or the past year. And certainly RIG fits the bill on all those cases. Or on all those metrics. One of the, I think, most important metrics, certainly for value investors, if you're looking at RIG, is the price to book ratio. Right now, RIG trades for about $4 per share on the open market, and the book value of RIG is $18.58. So the classic, buying dollars for pennies. You can buy shares of RIG for 22 cents on the dollar, and the tangible book value is basically almost the same. The tangible book value is $17.95 per share. So it's a great value play. It's going to have a lot of volatility in that stock, but if you're willing to hold it for a number of years, I think that oil is not going away. There's a study saying that we've hit peak gasoline, and that may be the case, but there's still a lot of oil used for jet fuel and for a number of other products worldwide. So it's not just going to be displaced by the EV market instantaneously. So I'd actually be kind of a hold your nose buyer of RIG. It doesn't rate well overall, but I think it's a great value contrarian play, and it does have near-term momentum. So I'd actually be taking a nibble at it right now.
Very good. And those two questions that we just asked, Adam, came from our YouTube channel, and you can obviously post a question there underneath this video. This next one comes from our email address, our email inbox. That's feedback@moneymarkets.com. And this one's a little bit broader, not necessarily a stumper because we're talking about the system you actually created. And the question is why do certain stocks rate lower in the green zone ranking model? And I think that's a great question to ask. Because there's a lot of things that go into it, and I kind of want you to be specific here about a couple of things in terms of why certain stocks rank lower. Because you just mentioned RIG. RIG rates a 35, but there are 6 factors that go into that. So I want to talk about that a little bit. Probably can't get into everything all at once, but why do stocks rate lower on the green zone rating system?
Sure. Well, we don't have time to cover all 6 of the factors, but let's cover 2 of them today. So 2 of the ones that are a little bit less intuitive are the size factor and the volatility factor. So size is basically looking at the size of the company based on market cap or enterprise value. And in this situation, all of the research shows that on average, in the aggregate level, smaller companies outperform larger companies. So that hasn't necessarily been the case in this bull market when big tech has dominated, but over a multi-decade and 100-year span, smaller cap companies can outperform larger cap companies on average. So if you go to moneymarkets.com and you type in a ticker symbol in the green zone stock rating model, and you look at the size score, if you see a high score on size, like 80 or 90, that's telling you that this is a small company. It's more likely to outperform larger companies since it's small. Likewise, if you see, on the other hand, if you see a low score, that means it's a large company. Like I just typed in Apple. Apple earns a score of 0.12 out of 100. So it is obviously larger than all, but 0.1% of companies out there. Maybe Tesla now, I guess. So basically, if you're looking for small cap companies, you want to go to moneymarkets.com and look for companies that rate high on size. Likewise, volatility is kind of one of those inverse or counterintuitive ones. Again, the academic research shows that low volatility stocks actually outperform high volatility stocks. And it's, again, counterintuitive because a lot of people know that stocks are more volatile than bonds and you can make more money in stocks than in bonds. And that's true at the asset level. But if you look within the stock market, within equity markets, you actually get better returns from low volatility stocks than you do from high volatility stocks over the long run and in aggregate. So if you go to moneymarkets.com and you type in a ticker symbol, if it has a high volatility score, like 80 or 90, then that means it's actually a fairly low volatile stock, and it is more likely to outperform. So again, in this regard, you want to avoid stocks that are rated low on size and low on volatility, because then you're more likely in a large company with high volatility, and that's not always the best bet. The size factor is one that we will sometimes overlook. If 5 out of the 6 factors are rated very high, but it has a somewhat low score on size, just meaning that it's a large company, we'll sometimes overlook that just because right now, large cap stocks are outperforming. So you kind of have to go where the market is. But those are 2 of the factors that would cause a stock to rate a little bit lower on our 6-factor green zone model. Again, you can have access to this for free at moneymarkets.com.
Exactly, and those are just 2 of the 6 factors, and I'm sure down the road we are going to be talking about the other 4 and then bringing it all together and kind of painting that picture for everyone. So make sure you keep tuning in to Ask Adam Anything and send your questions. You can do so by dropping a comment down below on our YouTube channel, or you can email us feedback@moneyandmarkets.com. So Adam, thanks for having me on. Appreciate it, and look forward to doing this again.
Thank you, Matt.